Savvy investors know it's smart to have buy and sell rules. For IBD investors, that means being strict about cutting your losses when a stock is down 7% from where you bought it. This helps prevent massive losses that are too big to recover from later. But what happens when you have a hyper volatile stock? A stock that makes keeping to your sell rules difficult. For example, if a stock routinely rises or falls 5 to 10% or more on a daily basis, or moves 10% to 20% within its weekly range, it often becomes very difficult to apply IBD sell rules to control risk. A highly volatile stock like this can whipsaw you out of a position even as it's staging a powerful run higher. This is why knowing a stock's average true range can help investors avoid getting whipsawed out. Knowing a stock's average true range is also important for identifying a stock's character. Is this a relatively volatile stock or not? And once you know what's the average for the stock, you know when it's acting out of character. Average true range is a key way to determine this. Here to explain how to incorporate average true range into your investing is IBD's Mike Webster.
So everything that we're trying to do with charts is to know what's normal and natural for them. And so a 2% move on every stock is not equal. A 10% move on every stock is not equal. You want to know relative to itself, is that 2% tiny, or is it big or average? And the easiest way to do that is to use the average true range. And so that just measures how much it travels on any given day over a set period of time. And I like to use the 21-day ATR look back, that historically everyone has always used 14 days. And so everyone keeps using 14 days because that's what everyone else used. And I don't, that's not how I like to do things. So I'll use a 21-day or a 50-day, but use whatever time frame that you like. And then I like doing it in percent terms, because just knowing that it travels $2 or $5 doesn't tell you anything. What you want to know is how much is that on a percentage basis, so you can compare apples with apples. So right there, you've got Walmart. Great example. That only travels 1.71% on average over the last 21 days. Now, of course, that'll change, and you'll have gap ups or gap downs on earnings, which will change that. So if you want a bigger time frame, you can use the 50, but I like using the 21, or that stock above it, NBIS, that travels 8.4% on any given day. So the fact that this is down 4% today tells you nothing. It's just completely normal and natural. It's never fun to be down, but it's only down half an ATR. So up a half an ATR or down half an ATR, meaning 4% on a stock that has an average of 8%, or actually 8.4, that's not a big deal. Now let's go to Walmart and picture in your mind, if Walmart was up or down 4%, what that would look like. That would be really big, because, with 1.7% is your normal day, 4% is really going to stand out. So that's why we use it. Is one of the reasons why we use it is, as you said, it's the character of the stock. So you know what you're getting into. It's very rare for a stock to have a 1.7 ATR to all of a sudden start having a 15% ATR overnight. You would have to have a big change in news flow for that. Like, Oklo is a perfect example. That's 15% normally. So the fact that it's down 8% is not out of character for this move. It's not even a full day's move on that. So that helps. And what I would suggest people do is stop thinking in terms of percentage and start thinking in terms of ATR. And that's what I'm doing personally to convert my thought process into ATRs. And hopefully in the future, we'll add more bells and whistles into market surge to be able to do that. I add the 21 and the 50 to every single one of my list panels. It's the first thing that I'll look at is
Mhm.
the ATR. And just to give people a sense, for the IBD live watch list that I create every day, I will typically not put anything on there that has a 7 or higher ATR. So
Mhm.
yeah, there's your 21-day. You can just pull it and drag it in, or you can
Mhm.
do the same thing with the 50. If you want to keep it simple, just use the 21-day ATR.
Mhm.
So again, it's just the measurement of how much it actually travels. So it takes into account if there was a gap from the prior day. Otherwise, it's just how much it's traveled on
Mhm.
that day. For most people who are new to trading, you're going to want to go with a much lower ATR. So if you're in your first 1 or 2 years of trading, I would suggest looking at ATRs that are under 3%. Now, those aren't going to be the fun stocks. So every once in a while, you will venture off in to some of the ones that are a little bit more wild. But your average, your typical stock should be,
Right.
on the low side.
You can also use this in conjunction with risk management when you're looking to buy, right? So if you know a stock is X% above a key moving average that you like trading off of, but in an average day, it moves, it would be down, however much percent below your stop. That's really helpful for risk management, right, Webby?
Extremely helpful. So you're looking at both of those together. And then frankly, I would prefer a world where we don't even look at percent. We only look at ATR. So two ATRs above the 50 or one ATR above the 21 and thinking of in terms that way. And that's hopefully where we'll get in the future. But yes, for your stops, you want to look at it and say, okay, here's a logical stop, let's say the low of the day before, or in your case, a moving average, let's say the 50-day moving average, and then just calculate in there. So if it were to go down there, would that be a normal day or not? And again, you're looking for a perfect stop, which doesn't exist, but a near perfect stop is one that would break the stock's chart and make it look funny. And how that would be an abnormal ATR. If the stock normally trades 8% on a given day, a 5% move is not going to break that chart. It's going to look normal and natural. If you have a 1.5% ATR or 1.7, like we were looking at, and it's down 8%,
Right.
that's going to break the chart,
Mm-hmm.
temporarily for, probably a few months.
Right.
So that's how you want to look at it from a
Right.
risk management standpoint. Just what type of merchandise are you playing with? Are you playing with the wild and crazy ones? Are you trading with the more conservative ones? And keep in mind, when you go into earnings, all bets are off because that is a crapshoot up or down. So
Right.
it's not it that's not that helpful on earnings days,
Mm-hmm.
frankly.
Right. Okay. So, final thing here, super quickly. What parameters would you set? So, here we have opened a new screen. If you go into price and volume, towards the bottom of that list, number 39 is the 21 ATR percentage. So, if you were to be screening off of this, of course, there's other fundamental and technical parameters, of course, that you can set. What would the ATR parameters be here for you,
I
Webby?
would set for someone new, I would set it max at 3%. For someone who's been trading for a while, I would set it at 7%.
Mm-hmm. And then you can layer that on top of,
Yeah, so on top of that would be, then I would say above the 50-day moving average,
mm-hmm.
above the
Okay.
200-day moving average. So let's go
Mhm.
into that. I just put a 0 there
Yeah. 0 for 200-day and 50-day.
and 50-day.
Mm-hmm. Okay. What
Go
else?
up to your price and put it
Mhm.
above $10.
Okay.
And then just one
Price
more one more parameter and we'll be done.
minimum 10. And
And
then,
then we're going to do our dollar volume, not share volume, dollar volume.
okay.
Um,
Dollar volume
and I would do that
here.
at 25 million. So you put in 25,000 there and it'll, yeah. And that's it,
Okay. Great screen.
703. And if that's too many for you, you can bump that average volume up to 75 million. If that's
Mhm.
still too much, then I would start with your 200-day moving average and I would bump that up to over 10% above your 200-day. And then
Mhm.
on top of that, you could just let's just slap a composite rating on there of
Yeah.
88 or higher, which 88 was Bill's favorite number for composite. And that'll automatically
Yeah.
exclude all the ETFs and things. So now only 162.
Yeah. That's a
Do
manageable
that in 10
screen.
minutes.
Done. Boom. Great stuff. Thank you, Webby.